Hello, my name is Mike Sinibaldi and welcome to this week's video edition of Heard on the Street. In this edition, I'm going to take a look at the following markets: the emini S&P, Euro-US dollar, crude oil, and the FTSE 100. The first market that I'm going to talk about is the S&P. At the monthly chart level, resistance above the market surrounds the 0.786 retracement of the entire bear market decline at 1390 and a quarter. Should the market trade beyond this level, odds are that a new recovery high can be expected. I bring this up because I can anticipate what the big money is going to do based upon this chart. I've added the MACD predictor that shows what price the MACD will create a sell signal. For the month of June, it's 1210 and a quarter. You might say that's over 86 points away. What's the fuss about? The fact is that the indicator has been creeping up, going unnoticed by most retail traders as they focus on lower time frames. There are two scenarios where big money can trap retail investors and add the fuel necessary to obtain their objectives. First, I can anticipate the market being sold without mercy to below 1243 and a quarter. It doesn't take much imagination to see how the MACD predictor could cross at this level. A cross should bring in additional shorts while stopping out all the weak longs that initiated positions and placed their stops below the most recent swing low. Together, that will drive the market initially lower. Should the market fail to recover, say goodbye to stocks. Case in point was October of 2007, when price broke the MACD predictor, then continued in a precipitous decline. However, there is a more sinister plot where the market is sold without mercy to below 1243 and a quarter in a stop running exercise to liquidate all the weak longs. This again creates an MACD sell signal, but one that fails, where the monthly close in price renders the signal invalid because in this case, the same market participants who drove down the market will buy those stops as well as cover their shorts in sufficient quantity to place a floor into the market. When they do, traders who took shorts on the break of 1243 and a quarter or the MACD cross will now be trapped and the market will recover to new highs. Anticipating market moves can be dangerous unless we can add evidence that builds a case for what we anticipate. At the weekly chart level, support below the market is between 1241 and a quarter and 1246. Suspiciously close as the 50-period simple moving average usually provides a key area where large institutional money steps up and adds to their positions. So in the coming days, I'll be looking for the market to sell off to these levels and hold. At the daily chart level, I've been favoring an expanded flat interpretation over the running triangle, where wave A and wave B are already in place, and we're now working wave C to the downside. Given the information that has already been presented, the expanded flat makes sense as the preferred count. The chart that I left readers on June 1st shows exactly how I expect wave 4 to unfold. Notice that I've raised a level of degree up one level. Friday's decline was certainly constructive, but I'm still waiting for a break of the lower boundary of the price channel, which confirms that wave 3 is underway. So for the early part of next week, expect further selling pressure. At the weekly chart level, the Euro-US dollar pair completed a double zigzag pattern which terminated at 149.39. The decline from 149.39 to 140.47 was in 5 waves. At the daily chart level, from the termination level of wave 1, we can see that wave 2 is unfolding in an expanded flat, A, B, C. But upon further inspection at the 240-minute chart level, one can see the subdivisions of wave 2 circle. The fact that price has exceeded the point where wave C equals 1.618 of wave A at 145.77 is concerning. Also, the slope of the most recent advance from wave 4 blue forewarns that the wave count may be flawed. However, if the count is correct, the market can make only one more minor push to new highs, then it must decline below 144.51 to confirm that the rally has ended. The next market that I'll cover is crude oil. At the weekly chart level, there is a significant amount of Fibonacci relationships as well as the physical count that led me to call for a top in this market. First, wave C circle equals wave A circle at 108.60. Secondly, wave 5 equals 0.618 of the distance traveled of waves 1 through 3 at 109.975. Finally, wave 4 divides wave C circle into the golden section at 110.925, where waves 1 through 3 measured from the wave 4 termination point equals 0.382 of wave C, and wave 5 equals 0.618 of wave C. At the daily chart level, this is the chart I left readers with calling for a move to 105, or the level surrounding the 0.618 retracement of the decline. The wave structure from 94.57 looks like a complex correction where wave A achieves most of the price target, and now the remainder of the pattern will consume time. The pattern will eventually resolve to the downside, but looks sideways to up in the short-term basis. The final market that I'll cover in this week's edition of Heard on the Street is the FTSE 100. At the weekly chart level, we can see that the FTSE 100 is tracing out wave 2 circle in a similar manner to that of the US S&P eminis. Put another way, can we gain an early advantage by watching the European markets? I think so. Should the FTSE trade down hard on Monday, then odds are that the analysis presented for the E-mini S&P is on track. I hope you found this video helpful, and best of trading.